Well, we appreciate Joseph. Thank you so much for inviting us into your community to spend a little bit of time on education today. My name is Jon Taylor. I'm a registered representative at JRW Investments, which means that I advise clients directly who are making real estate investment decisions. I'm joined by Ryan Thomas. Ryan and I serve together on the executive leadership team at JRW. He also manages clients independently. And more, we serve clients, especially the more sophisticated private wealth or family office clients. We serve them as teams. And so you may, reach out to either one of us on the heels of this call. The QR code on the bottom left it gives you a really easy way to reach out to us. We're open to have just high-level educational conversations or answer your questions specific to your clients. Or if you are an investor yourself, it is interesting to kind of overlay how does the 1031 exchange and the Delaware Statutory Trust, how may that benefit you as an agent or as a broker or as an investor? We'll get into it here today, but we appreciate your time. Up front, I do want to make it clear that this is just an educational presentation. We are securities licensed brokers. When we do make a recommendation to a client, it is based on suitability and based on the client's individual needs and goals. We'll talk a little bit about tax, but we are not CPAs. And so anytime that we're advising clients, it's in conjunction with their tax professional or their attorney. Three things, and we'll see if we can remember this over the course of the next 45 minutes, right? What we want to learn today is how to decode this thing called the Delaware Statutory Trust. My understanding is that you've had exposure to this in the past, and there are plenty of questions about it. So we're going to leave time at the end for questions. I want you to remember that today there's generally 60 to 100 plus private real estate investments that are available for the 1031 exchange investor that are structured as a DST. Okay, so for some of you, that number may be like, wow, that's way more than I thought. And for others, it may seem like, well, that's a really small market. But depending on who you interact with, I think having that knowledge will put you ahead of the curve in terms of understanding where to start in this market. And then lastly, whether you're an agent or a broker on this call and you serve your clients or you're an investor, I want you to feel empowered to act on the information here. I think my goal is for this to be very tangible, very practical, and very actionable immediately. So who is JRW? JRW Investments is a wealth management office. We specifically focus on sourcing, identifying, vetting, screening private placement real estate securities on behalf of our clients. Our clients tend to be the retiree and the retiree who has had broad and extensive real estate experience, both residential and commercial. Perhaps they've been in business as partnerships or through syndications. They're generally a sophisticated investor. However, if they own real estate investment property, we can certainly help them with guidance and expertise. Just a little bit of background. JRW started, our origin story is a pure play tax practice. So our founder ran a CPA firm for many years, 20 plus years. And that CPA firm, as many do, their clients are trusting them for broad advice. CPA firm added financial services broadly. So the equities, the mutual funds, the annuities, the insurance products. In the early 2000s, so we started in the 80s, right? In the early 2000s, we added financial services and financial planning to the practice. And by the early 2000s, we recognized that real estate was a huge part of JRW's focus from an advisory standpoint. We're located in Southern California, and it seemed like whether or not our clients were the doctor, the lawyer, the engineer, the entertainment person, they had accumulated significant real estate wealth. And they were reliant on the 1031 exchange, amongst other tax advantages to help them protect, preserve, and grow their real estate wealth, not just through their lifetime, but also as they were planning for multi-generational wealth growth. Where do we fit today? We are not the CPA, but we work really well with the CPA. We don't provide tax advice directly, but everything that we pursue in real estate has some sort of tax efficiency or tax advantage. We're not a lender. However, we can solve complex problems on the debt side as it relates to the 1031 exchange. We can go into that. We're not the financial advisor. We don't comprehensively advise on the entirety of an investor's net worth. However, their real estate tends to become an extremely important part of their financial planning. And there's a gap there where they need somebody who has sort of a financial planning background, but real estate expertise. We're not the attorney, but most of our clients, they own property in the living trust, or they've inherited property through a trust or through an estate plan. And we're very involved with the attorneys of our clients. And most importantly, we're not the listing agent or the broker. We have a part of our focus that is in training and equipping the local agents, both on the commercial and the residential side, to win more listings, to generate listings with the use of the information that we're going to give today. So that's really where we're going to focus. JRW's passion is to empower our investors to be secure, free, and generous. And we think that those three words go together in order. Our retiree client, as they're looking and planning for long-term retirement, maybe they're exiting their W-2 job, or they're looking at a real estate portfolio, security is their number one objective. If we can provide the security from a lifestyle standpoint that they're looking for, that enables them to enjoy the freedoms that come with retirement. And oftentimes our investors are motivated by this idea of generosity, both on the margin of what they're creating, the wealth that they're creating, or the income that they're creating that's extra during their lifetime. But also the 1031 exchange motivated investor is oftentimes motivated through generosity in their own family. They want to protect what they've created. They don't want to give that away to the government unnecessarily through taxes. And they want to bless their children or their grandchildren, future generations, by preserving that equity and growing that. So how do we accomplish that? The purpose of JRW is to source real estate investments for our clients. That's really what we do all day, every day. We're focused on understanding the broad commercial markets from a macroeconomic standpoint, and we apply our understanding of opportunities and real estate investments that are built to solve our clients' tax problems and wealth management goals, and apply that through the Delaware Statutory Trust market for our 1031 exchange investors. So let's put all those pieces together briefly. We bring the tax expertise that enables your client to feel supported through their relationship with their CPA, and an understanding of the decisions that they're making in a tax efficient way. We have broad macroeconomic exposure to the commercial real estate markets across the country, and we underwrite. We perform due diligence on probably 300 or 400 commercial real estate properties per year. So we have an extremely sophisticated underwriting group. You can think of us like in a family office or in a public REIT or in a private wealth group. There's a acquisitions director who's looking at many properties throughout the year and advising their clients on what to purchase. That's the role that we play for our clients. And we're able to do that effectively through the Delaware Statutory Trust market because we have access to the broad market. It's our goal to underwrite every single DST in real time and have our finger on the pulse of the very best opportunities for our clients during their 1031 exchange window. Here's something that's a really interesting stat, and it's really great for those of you on the call to recognize. We are benefiting from a significant tailwind, macroeconomically speaking. Okay, every day, approximately 11,000 Americans will retire, or they'll turn 65. When our clients are nearing or entering retirement, they're typically evaluating their financial plan from an entirely different lens and scope. They're asking questions like, do I have enough to live for the rest of my life? Are my affairs in order if something were to happen to me from a health standpoint? Their risk profile changes, their goals are changing. And for the real estate investor, it's important to understand that when you're speaking to a 35-year-old and you're speaking to a 70-year-old, it's a very different conversation motivated by very different goals and objectives. The conversation today is focused on the retiree. That retiree, that generation controls a significant amount of real estate wealth. Over $23 trillion is held by the retiree, generally speaking. And the majority of those investors at some point will want to alleviate themselves from the day-to-day management of that quote unquote business. Okay. Those of you who are investors understand that running a multifamily property or a portfolio is a business. Okay, you're looking every day at your top line revenue and your expenses and managing that alongside of your managers. If you're an agent or broker on this phone call, you recognize that this is a significant problem and opportunity for you to insert yourself in a solution. Most of these investors at some point will need a tax deferred 1031 exchange. So being proficient and understanding that is going to be really important for you to succeed. But also, every one of these individuals will hear from either their financial advisor, their CPA, their attorney, their friend, a family member. They will hear about a Delaware Statutory Trust from somebody. And I would suggest that it ought to be from you. You ought to have enough cursory overview information to understand when does it apply to your client and speak that language. And it will set you apart from the average broker or agent. We like to tell real estate investors, sort of tongue in cheek, that every day you get to choose one of three options as you evaluate your real estate investment portfolio. Number one, you can hold the property, right? You can continue to do what you've been doing yesterday, enjoying the cash flow, managing the expenses, managing the tenants, thinking strategically about how you're growing. At some point, most real estate investors sell what they own. And when they do that, they have another option, which is to pay the taxes or to perform a 1031 exchange. And so to speak to the investor at every stage with proficiency is of great benefit. If you're serving investors, if you are an investor, it's important to justify a decision on each one of those on a regular basis. So a question that I like to ask my investor clients early on, as I'm starting to get to know how they're invested and what their experience is are all of your current investment properties working for you? Okay. Are they all working for you? And what does that mean? Is it working for you economically? Is it working for you from a time standpoint, from an energy standpoint, from a burden standpoint? And what you'll hear about their darlings in their property portfolio. And you'll also hear about their dogs. You'll hear about the problems that they're having, and there'll likely be a property in their portfolio that's not working for them for whatever reason. For my 75 to 85-year-old investor, at some point, all of them are not going to be working for them. They're not going to want to spend the time and energy that it takes to manage that property. And so that's something to listen for. Oftentimes investors, if you're an agent and you're getting to know an investor and trying to understand their potential for a sale, you may hear them say, well, I'm going to hold these properties for the rest of my life because I want my kids to get the stepped up cost basis, right? And that's exactly right. What we acknowledge is that we want our clients to stay in real estate if they have a sizable gain for the rest of their life, because the end of life tax benefit for their estate is significant. But a good question to ask is, okay, well, who will sell your properties? When will they sell them and why? Are your kids in the business, right? Are they going to continue to run your real estate empire or company for you? Or are they off doing their own thing? Are they doctors, lawyers, engineers? Did they move out of state? Are they focused on their own scenario? Another question, are all your kids the same? Are they all in the same economic position? Are they all in the same emotional position as it relates to your portfolio? So having an understanding of estate planning from a real estate standpoint, from a planning standpoint, will be helpful in understanding which properties, if any, might be a potential to be sold and why. If you do sell the property, it's important to understand the tax implications, right? If you're speaking to an investor about a listing, or if you're an investor yourself and you're thinking about selling, you would never do that without two things. Number one, understanding what your tax implications are of a sale. What will you owe the federal government if you just cash out? Or number two, most investors on the commercial side are tax efficient. They understand the 1031. They've likely performed a 1031 exchange. And so you're not going to get the listing, or you're not going to think about listing if you're an investor, unless you have an understanding of what you're going to buy. I also like to say people don't move away from problems in real estate. They move toward opportunities. And so to have that conversation early on, you need to understand where are the opportunities. And so for us, again, that goes back to our sourcing program. When I ask somebody, are you confident that your current properties are performing optimally? I need to understand what is optimal, what's optimal in their local market, and what's optimal nationally. Because if I'm going to have a conversation about a listing, I need to have a conversation about an acquisition. And there needs to be a grass is greener proposition for that investor on the other side. Common motivations for my clients: they want to defer or eliminate their capital gains tax. Okay, somebody who's thinking about a listing, who is tax efficient, who has broad commercial real estate experience, understands the tax scenario. They also, other motivations, they may want to leverage a property. They may want to diversify away from the geographic location or the asset class that they're currently exposed to. They may want to grow from residential into commercial, or grow asset classes for risk reasons or opportunity reasons. They're always looking at cash flow, right? Every day that you own real estate, you have a choice of owning any real estate that you like. You can sell and buy with no tax implication through the 1031 exchange. And so the question is what you're owning today optimal from a cash flow standpoint, from a management standpoint, from an estate planning standpoint? And so those are all conversation topics in a listing appointment that our agents and brokers that we're talking to are commonly asking. Common impediments to the 1031 exchange. So if you're thinking about selling as an investor, or if you're an agent having these conversations, you may hear these objections in your mind or out loud. I don't want to buy something that requires the same issues I have. Okay, I get it. My grandkids moved from California to Idaho, and I want to follow them, but my properties are here, and I'm kind of stuck. If I do a 1031 exchange, I still have the same issue, right? I still have the same management burdens that I have today. Or this particular property represents 50% of my total net worth. How can I make that decision in 45 days? That seems like a very stressful scenario. Or, hey, I've got a great loan. My loan is 4.25%. And how can I replace that loan today if I were to sell? There's a lot of folks sitting on assets that are not working for them because they think that their loan is just too great to sell. Another interesting conversation to ask: when does your loan balloon, or when does it mature, or when do you need to refinance? Because there's a lot of that coming. I don't want to own property here anymore. I don't intend to move away from Southern California in my scenario where I live. Right? I don't intend to move away, but I don't want to invest here. I'd prefer to invest in more investor-friendly states, landlord-friendly states. And so how can I do a 1031 exchange if I'm just going to have the same scenario? And so with that, I'll ask Ryan to introduce the Delaware Statutory Trust. All of that is sort of this preamble to conversations, environments, scenarios that you'll find yourselves in, whether you're an investor, whether you're a broker. And so the DST market for the last 20 years has been built to overcome a lot of those impediments. And so with that, I'll turn it over to Ryan.
Yeah. Thanks, Jon. Jon and I get approached several times a week by existing clients and industry adjacent partners. So that would be brokers, CPAs, attorneys, wealth managers, and their referrals. And they're looking into the DST vehicle. As Jon mentioned, it's been around for over 20 years, but it's like a snowball. It's growing in popularity and has really over the last, I'd say, 5 years or so. And these could be investors or industry adjacent partners where the client is considering a sale. Maybe they're already under contract, or in some cases, we're working with investors where they're well into their 45-day identification window for their 1031 exchange. And I'd say I agree with the impediments and solutions that Jon had mentioned before, that these are, I'd say, you fit into one of a few categories. You're the investor who wants to move 100% into passive, and you have a level of desire for diversification and safety. I'd also say that we work very commonly with investors that are trying to use the DST structure as a way to quarantine their 1031 exchange debt so that they can be a strong all cash buyer with local property and or with maybe a commercial property that's out of state, but they know that it's going to be highly competitive, and so they'll carve off a piece and put it into a DST to take care of that debt issue and make them a faster close on the other side. And then we also commonly engage with investors who are just looking for additional 1031 identification options. Maybe they've found one or two that are local, and now they just want to round out their ID sheet, and so they're looking to us for a solution. The Delaware Statutory Trust is just simply a way to title real estate. Back in 2004, there was a revenue ruling 2004-86, where the ruling clarified that a DST is classified as a trust for federal tax purposes rather than a business entity. It's going to feel a lot like a limited partnership syndication, okay? But it's very important to know that it cannot act as one. And so the IRS did put particular restrictions on the entity structure. We call it the 7 deadly sins of DSTs. You're welcome to look that up on your own time or have a conversation with Jon and I after, and glad to go over those. But the classification is crucial because it allows the DST to be treated as a pass-through entity for tax purposes, much like a single member LLC, or if you or your clients currently invest through a living revocable trust, it'd be treated in the same way. These are most commonly structured as a private real estate securities offering, which can be sold by investment advisors and licensed securities brokers. And it's also important to know that this is only available when it's structured that way to accredited investors. So that's investors who have a net worth greater than $1 million, not including their primary residence. That's them and their spouse combined. Income of over $200,000 a year if they're single, or $300,000 a year if they're married, or if they're investing through a deeper, more complex entity. The entity has to have $5 million worth of gross assets inside of it, and that's put in place by the Securities Exchange Commission and FINRA. That's not something that we set. These properties are stabilized and have predefined investment objectives. So essentially, the DST is a legal structure that allows potentially hundreds of investors to own fractional interest in professionally managed institutional property or portfolio of properties and still qualify for a 1031 exchange. So we might have investors that are moving out of single family homes or condos or duplex, or maybe they own a small office, and they're now gaining access to really large assets where they might own a fractional share in an Amazon distribution center, or in a Kroger grocery store, or in a much larger 200, 300 unit multifamily complex. This particular structure, being a pass-through entity, it is a form of a grantor trust. So there's a trustee and beneficiary relationship. The trust owns the real estate, and the trust has a bank account, okay? Much like maybe your LLCs do, or your own trust does. Now, with the trustee and beneficiary relationship, the sponsor, okay, the professional real estate group that's whose job is to acquire the real estate, manage the real estate, and eventually sell it, they start out as the 100% owner of the trust. They're the sole beneficiary of the trust to begin. Okay, so they go out, they acquire real estate, they package it underneath the trust structure, they own it entirely, and then their job is to market it for sale. Okay, at 1031 exchange, investors are going to come in and effectively buy out that sponsor company from their position. And so you can have an investor that comes into a $100 million deal with $1 million. They now own a 1% beneficial interest, and the sponsor now only owns 99. And the sponsor will continue to sell out that program. The sponsor, what are they motivated by? Well, they're entitled, like in most real estate syndications that we'd be involved in, whether that's REITs or limited partnerships or opportunity zones. The sponsors in this case are getting an acquisition fee, essentially a commission for putting the deal together. They're also able to take ongoing management fees, and those typically scale with how management intensive the asset is. So your hotels will have higher management fees on a percentage basis of the gross rent than maybe a triple net Amazon distribution center. Okay. And then the last place where they may be allowed to make money, or where they should be able to make money, is through a disposition fee when they sell. Unlike all the other entity structures that I just mentioned between OZs, limited partnerships, REITs, in a Delaware trust, one of the distinguishers to not allow it to be a partnership is that the sponsor cannot share in the profits with investors. Okay. So the investor is coming in, and all of the net benefit that comes from the real estate belongs to the investor pro rata. So the investor is going to get their share of net rental income, usually distributed on a monthly or quarterly basis, except for maybe what the fund is going to hold back in retained earnings, or we call it reserves, basically money that's going to be set aside for deferred maintenance, future improvements on the property, releasing, that sort of a thing. The investor also has access to depreciation benefits, or basis carries forward from their relinquished property into the DST or DSTs they invest in, so they can continue to take depreciation on the building and improvements. And then also the investor is entitled to their pro rata share of the net sales proceeds. Okay. So that's all really key here. This is not an investment that necessarily has guaranteed returns tied in. The question is often, well, I want this, and this. I'd like to see cash flow. I'd like to see appreciation. And what we always go back to is that is absolutely achievable, but it's always going to be based on how the particular asset performs. Okay. So the key benefits and advantages to DSTs is obviously is this passive ownership. As a beneficiary, you are taking a back seat and relying on that professional real estate institution to handle all of the landlord duties, all of the property management responsibilities that you were used to taking care of when you own properties individually. You have the ability to invest into properties that are otherwise inaccessible to most individual investors. Okay, so I gave some examples earlier. You can transition, from a property that maybe you're selling for a couple $100,000 into something that might be tens or hundreds of millions of dollars in size. The typical minimums, because you can have conceivably hundreds or thousands of investors in one of these programs, is the normal minimums might be $50,000 or $100,000. In some cases, we'll see it be a lower minimum or maybe higher than 100,000, but typically that sweet spot is right around 100 grand. You also have the ability to diversify. So you can diversify into a fund that maybe has one or several properties inside of the one DST. You can also, because of the low investment minimums, you can reinvest into multiple funds that may span several real estate sectors and geographies. And then you also have access to non-recourse financing. So as you'll recall, the 1031 exchange guidelines require that investors purchase property that is equal to or greater in value than what they sold. Okay. In the event that an investor has debt on their relinquished property, that means the investor must replace that debt. And they can do so with either taking on another mortgage or by adding cash to the transaction. Okay. So with DSTs, you can purchase DSTs that have a debt structure in place. You can also invest in DSTs that are not encumbered with any sort of mortgage. We typically find that the majority of DSTs that do have debt, their current LTVs, because of where interest rates are right now, are usually between 40 and 60%. So if I were to say the average is 50%, what that means very practically is for every dollar of equity that the investor is putting into the DST, they're technically buying $2 worth of real estate on paper. So some investors may choose to take on more debt than they need to in an effort, I'd say, to enhance their total return. So we saw that a lot 5, 7, 10 years ago when interest rates were really low. There was positive arbitrage to capture on the cash flow side of things. But we also see very commonly that our investors have fully depreciated their properties through lifetime of ownership. And by taking on this non-recourse financing through a DST, they now create additional tax basis, which provides brand new depreciation schedule for that new basis. So there are times and places, and we can talk through, the potential drawbacks to taking on more debt. But the market, what you need to remember is that the market can afford that possibility to those who need it or those who want it. So, and by the way, the client does not have to be underwritten into the loan. It's the sponsor who obtains that debt themselves, and then the client by default gets grandfathered in because they're a beneficiary of the trust, and so they'll report everything on Schedule E just like they're used to. These are also highly efficient for 1031 exchange purposes. Okay. Whenever you complete an exchange, whether it's into local property or DSTs, the same 45-day identification window applies and the 180 days to close window applies. And so what the traditional exchanger experiences when they're buying property that they're going to own and manage themselves is maybe their closing window is going to be anywhere from a 14-day window to 120-day window, depending on the type of property they're purchasing and whether or not they're using financing, right? And how much due diligence do they need to do? With DSTs, the marketplace has this constant inventory of programs that are immediately available. So all relevant program information is available to the investor and has been reviewed by our office before the investor is even considering the purchase. So we have access to the purchase and sale agreements, the appraisals, the sales comps, the historical and current rent rolls, the property condition reports, the environmental site assessments, even a third-party legal opinion on the structure, where it shows that the structure conforms to the IRS's guidelines set out in 2004. We even have a pro forma provided by the sponsor, the real estate group, with what their business plan is and what they think is achievable for the real estate that's inside of the DST. So because of this, when we present a program to a client, we can focus on the program specific attributes and risks and hopefully risk mitigants, and then facilitate the closing when the investors decide to go in. We can facilitate that within a few business days. It's really, really common for clients to come to us, make a decision, and then within 48 hours, they're fully invested and they're receiving cash flow right away. Okay. It is important to note, I forgot to touch on this earlier, with these funds, the IRS for 1031 exchange purposes wants to see that this is property being held for long-term investment and not being housed as inventory. So these are never going to be properties that are, fix and flips. These are properties that are stabilized, cash flowing. We're coming into the picture. So there's I'd say a lower degree of risk than there would be with maybe a syndication where we're going to be doing a lot of heavy development work and we're trying to really speculate out into the future. Just like the non-recourse financing, there is an inherent limited liability protection that's offered through the trust blanket. So, your clients and you yourselves may have invested in a lot of property, under an LLC. Okay. And so you're used to, putting all of your real estate into different baskets to protect the rest of your assets should something happen at one of the properties. The DST structure inherently provides limited liability protection for the client, where if something were to happen within a particular portfolio, no creditor could come after the client and their other DST holdings, nor could they come after any of the client's other financial portfolio. Okay. And so a lot of times we'll have investors asking if they need to keep their LLCs, and we'll tell them no. You have a single member LLC, you can invest in your personal name in a DST. You can invest through your trust, and you have the same protections that you did before, but now you can dissolve your entity. You no longer have to maybe pay the statement of information fees to those states. You don't have to hire a registered agent for when you have an LLC that's doing business out of state where you reside. Okay, so that's inherent here. We also have the ability, I mentioned this before, where you're getting to retain your cost basis from the property that you just sold, and you still have access to the same depreciation benefits. You have the ability to devise these fractionally. So should you want to do any gifting to your children or heirs or others, it's very easy to retitle. We don't have to go through the same process of changing deed or anything like that. Upon death, if it needs to be distributed amongst heirs, again, very easily divisible. We're seeing this more and more. I'd say over the past 5 to 7 years, it's grown in popularity. But the DST is now a pathway to a REIT in many instances, and REITs have additional benefits of being even more diversified and more liquid than maybe a DST structure or individual property ownership structure. Where also I think gained a lot of traction is it seems about every 4 years, 1031 exchanges are at risk for being modified or removed from the tax code. And this pathway to a REIT involves a different section of the tax code, which has never been at risk of being on the chopping block as far as Congress is concerned. So John will probably touch on that a little bit later if we have time. So what are the key considerations? What are the reasons why investors walk away from a conversation with us and go, yeah, you know what, this just isn't the right fit for me? Okay. That primarily stems around the fact that you are giving up control and you're losing flexibility. Okay, so investors, it's the other side of the coin of being passive, which most desire, but you don't have voting rights. You are far away from your asset. You're not tangibly touching it. Okay, and that can be rather difficult for certain investors who maybe are so used to handling everything themselves and been doing that for decades on end. Additionally, a common question we get was, how liquid are they? Can I sell it if I want to sell? And the DST structure, it doesn't offer an active secondary market. These aren't traded on any sort of exchange. So DSTs are typically bound to a hold period that's set forth by the sponsor. Now, it's not a hard and fast date. We're going to sell by, August 15th of 2035. We're provided with some general guidance. And typically these programs will have somewhere between a 2 and 10-year holding period without an opportunity for an investor to exit early, typically. The debt structure is typically the framework for the exit time horizon. One of the 7 deadly sins is that DSTs cannot refinance under their structure. Okay, so most commercial debt is structured on a 5, 7, or 10-year term. Okay, so whether it's 5, 7, or 10 years, or in some instances longer, that's going to provide that outer boundary. That's probably the longest that the DST would last before the sponsor decides to sell the properties. There's also costs that are involved with DSTs. So investors are paying a fixed price that's determined by the sponsor. Okay, so this is different from going out and purchasing property on your own, where you have a seller who has a listing price and then you're going to negotiate, right? In this case, the sponsor is setting forth the price, and that price is going to be inclusive of all of the sponsor's costs that they incurred related to acquiring the property, and also what was involved with establishing and marketing the DSTs. And then it also includes reserves that are going to be set aside up front in the funds bank account for future property improvements and deferred maintenance. Okay, so it's a one wrapped in total price that the client, the investor, is paying to get into the deal. There isn't a negotiation that takes place. It's more of a take it and leave it. DSTs come with a set of underwriting assumptions, but we can't simply rely on those because they're provided by the sponsor. We have to remember what the sponsor's motivation is, right? They want investors to invest in their program because that's how they make their money, right? Through the acquisition fees and the management fees and then the disposition fees. And real estate is speculative. We all know that nothing is going to perform exactly how we think it's going to. And so we have to take those underwriting assumptions with a grain of salt. Just because a sponsor is forecasting a particular rate of return doesn't mean that that's actually what's going to be achieved. The DSTs, as I said before, bear the same economic risk and real estate risk that traditional property does. So if I could boil this down to maybe a comparative summary comparing commercial real estate to DSTs, both have a potential for income, both have potential for appreciation, both allow depreciation, carry forward basis, both allow the step up in basis. Okay. But DSTs also offer no management or sale responsibility. They're highly fractional. They're immediately assignable and distributable per an estate plan. Okay. And so with that, I'm going to hand it over to Jon. He's going to take about 5 minutes to discuss how someone can go about successfully navigating the DST landscape, and then we'll open it up for some Q&A.
Yeah, thanks, Ryan. So oftentimes we get to the point with an investor where they recognize that the structure of a DST is a good fit for them. They're looking to go passive. They're comfortable with the illiquidity. They're desiring the increase, oftentimes in income, that they're able to enjoy, and they appreciate the opportunity to evaluate a stabilized, fixed investment where all of the due diligence is right there to review. But the question is, how do you navigate that landscape as an investment? Today, I think there's about 42 different active real estate sponsor companies that have inventory available for an investor to acquire. And so it's good to know that there's that many groups out there. And it's good to know that it's a fairly small list. And so if your focus, like JRW, is on sourcing specifically from this marketplace, it's small enough that we can get our arms entirely around the market. It's also worth noting that we've been at this since 2002, and we have been focused on reviewing 1031 programs from sponsors like this longer than most of the sponsors on this list have been offering 1031 programs. And so we've, in many cases, we've reviewed every program that they've ever brought out to market for the last 25 years. And so what does that mean for us? We're looking at the entire market. That's a unique to JRW opportunity to have the scope internally to review, on average, 5 to 10 new offerings every month. We typically we see an asset class distribution that is about 25 to 30% multifamily, about 20% retail, about 40% industrial, and then there's a couple of other onesie twosie asset classes out there: self-storage, senior living, student housing. There's a variety of different types of institutional assets that you may see in a DST from time to time. But broadly, these assets fall into those three categories. Our office aims to review every DST that's on the market. We're very networked in with the major DST providers, and oftentimes they're in our office trying to pitch us on their deal so that we can then pitch our investors. And what they come to learn about JRW is that we have a really strict screening process. And so we have a full service due diligence office that re-underwrites every commercial real estate pro forma going forward for the next 10 years based on about 25 different financial variables that could change over time. My understanding is that you guys at ROI-Muse have a really sophisticated software platform. So you're used to looking at different variables that may or may not impact a deal. And so we're doing the same thing based on macroeconomic data and marketplace data. After about 2 hours, we kill a quarter of the deals that we look at just based on price. Typically, a fully loaded DST has a major hurdle to overcome for us, which is offering a competitive price in today's market. The deals that pass that screen, typically they're acquired by significantly large sponsor organizations that have advantages on the acquisition. They either have an inside track on an off-market deal, or they're really well capitalized and they can cash close quickly. And so they're able to acquire at a discount to fair market value that even with their load, they're still able to bring opportunities to our clients. After about 20 hours plus travel, we may approve up to 15% of the current market. And that means that we think that the real estate is going to perform reasonably to expectation. And then it's been structured to not only perform in the best of times, but also weather some challenging economic headwinds. We always underwrite more pain in the future than the sponsors typically would. And then when we're working with a client, we recognize that even though a program may operate as expected, that doesn't necessarily meet the goal of the client, right? It may have too much debt and the client's not interested in debt. It may have, this, that, or the other. And so there is this then match process that happens between what makes it through our screen and then what's a good fit for the clients that we're speaking to. I already kind of talked about this, but the three pieces of underwriting that matter in great detail, and again, this is like a 40 to 60 hour process all in. If we're going to approve a deal, it's the all-in price relative to the fair market value. So we want our investors to come into a deal with equity, that we want them to buy basis if they can. We also have a very keen eye on the operating model, right? The gross revenue that's coming in and how that could be impacted up or down, and also the expenses and what might be challenging expenses to manage, or what might be opportunities for a sponsor to efficiently cut costs and create value. And then lastly, the exit strategy, right? Our clients only recognize an IRR when the property is sold and equity or net proceeds are then distributed back to investors. And so to have a keen understanding of how they're targeting an exit and how the exits are intended to be structured is typically what we're looking at a very high level. From an exit standpoint, we typically see two distinct types of exits. It used to be all market driven. It used to be just the same as most of you own real estate. You buy a property because it's the right property to own, and then you sell it when it's the right time for you, or when somebody gives you an offer you can't refuse, right? A market driven exit based on the opportunities that are presented. That's today. That's probably about 50% of the DST market. The other 50% have what we'll call a strategic exit, where they're acquiring properties from the street, forming the investment vehicle already with an end buyer in mind, right? They become sort of a supply chain for a larger real estate investment trust or pension fund or private wealth client. And they recognize that they're creating an inventory or a pipeline for a larger group to acquire them in the future, almost like a merger and acquisition private equity deal where you'd buy a company because you can sell it. About half of the DSTs have a pre-structured exit with a very specific buyer in mind. Lastly, and then we'll stop for questions. Bonus topic. This comes up more and more. Hey, do you guys do UPREITs, or have you heard of a 721 exchange? This is a whole nother presentation. Maybe Joseph will have us back to do this presentation. But the 721 exchange is accessible for investors who participate in a DST with a strategic or structured exit where a REIT is the buyer. Okay, that REIT, that real estate investment trust, instead of purchasing that property or that portfolio of properties for cash, they exchange operating partnership interest in the REIT for the property itself. And it allows a tax-deferred exchange directly into that REIT, allowing for full tax deferral, broader diversification, right? Further estate planning considerations, and the primary benefit is liquidity. The REITs have a redemption program that allow investors, typically on a quarterly basis, to redeem their shares in the REIT for cash. And why would an investor want to do that? Typically, we see that happen either strategically as like a tax loss harvesting, offsetting losses with gains strategically through their lifetime, or most commonly, it's a great estate. It's an inheritance asset where the second generation who's inheriting the REIT gets immediate fractional uh, distribution and can immediately liquidate and turn that into cash at a stepped up basis. So that's a very cursory overview.